Imagine two people. Same city, same year, same starting salary. One of them puts $200 a month into an index fund at age 22 and never thinks about it again. The other one waits just a few years. Life gets in the way. They figure they'll start when things settle down. By retirement, the first person has $1.1 million. The second person has $380,000. Same income, same discipline, same $200 a month. The only difference was 10 years. That's not a typo, that's not motivational fiction, that's just compound interest running its course, quietly, indifferently, for decades. Now, here's the uncomfortable part. Most people know this, and most people still don't invest. Not because they're lazy, not because they don't care about money, but because the system that's supposed to help them get started is designed in a language that feels deliberately confusing. So today, we're going to strip all of it back. No jargon, no textbooks, no one trying to sell you anything. Just how investing actually works, why it matters more right now than it probably ever has, and what the people running the financial industry would quietly prefer you didn't understand. Here's where we are. Inflation has been doing something interesting to your money over the last few years. Even if it cools down, the damage compounds. $1 today buys less than $1 3 years ago, and $1 sitting in a standard savings account earns, on average, somewhere between almost nothing and still basically nothing. Meanwhile, the stock market, over any rolling 30-year period in modern history, has returned an average of roughly 10% per year. Not every year. Some years it crashes 30%, some years it doubles, but on average, over time, 10%. Your savings account? Usually under 1%, sometimes 4 or 5% during high-rate cycles, but historically, it barely keeps up with inflation, let alone beats it. This creates a very specific problem for people who play it safe. Playing it safe is not actually safe. Sitting in cash while inflation quietly erodes your purchasing power is, functionally, losing money in slow motion. You just don't see the number go down, so it doesn't feel like a loss. It is. And the reason this matters more now than it did for, say, your grandparents is that pensions have largely disappeared. Most workers today are not promised a fixed retirement income from their employer. They're given a 401k, a target date fund, and a pamphlet. Which means for the first time in history, the average person is responsible for their own long-term financial future, with no training, against institutions that have been doing this for centuries. That is the situation we're in. So let's talk about how the game actually works. At its most basic level, investing is just this. You give your money to something, and if that something does well, your money grows. The something can be a company, a government, a piece of real estate, a commodity, a collection of all of the above. For most beginners, the conversation starts and ends with stocks. So let's start there. When a company wants to raise money to build a factory, hire engineers, expand into new markets, they have a few options. They can borrow it, or they can sell small pieces of the company to the public. Those pieces are called shares. When you buy a share of Apple or Google or a company you've never heard of that makes industrial fasteners in Ohio, you are literally buying partial ownership. You're a shareholder. A tiny, almost imperceptible one, but a real one. If the company grows and becomes more valuable, your share becomes worth more. If the company shrinks, so does your share. Simple. Now, here's where it gets interesting. You don't have to pick individual companies. In fact, for most people, picking individual companies is a terrible idea. Not because it can't work, but because it requires time, research, access to information, and, crucially, the ability to be consistently right in a market full of professionals who are paid millions of dollars a year to also be right. The smarter move for most people is something called an index fund. An index fund doesn't try to pick winners, it just buys everything. The S&P 500, for example, is an index of the 500 largest publicly traded companies in the United States. An S&P 500 index fund buys a tiny slice of all 500 of them. Amazon, Microsoft, Tesla, companies you've never heard of, all of it, proportionally. The bet you're making isn't that one company will win. The bet you're making is that American capitalism as a system will continue to grow over the long run. That's been a pretty reliable bet for about 150 years. Now, within the index fund category, there's a specific type called an ETF, an exchange-traded fund. Think of it as an index fund that trades like a stock. You can buy one share. Some ETFs cost less than $100 per share. They're liquid, low-cost, and widely accessible. The fees matter enormously. This is not a small detail. There's a number called the expense ratio. It's the annual fee the fund charges you expressed as a percentage of your investment. Actively managed funds, where a human is picking stocks, often charge 1% or more per year. Index funds typically charge between 0.03 and 0.20%. That difference sounds small. Over 30 years on a large portfolio, it can be the difference of hundreds of thousands of dollars. Quietly extracted year after year before you ever see it. Fees are one of the only things in investing you can actually control, so control them. Section 3. The uncomfortable math. Let's talk about the number that changes how people think about time, the Rule of 72. It's a shortcut. Divide 72 by your annual rate of return and you get the approximate number of years it takes your money to double. At 10% returns, your money doubles roughly every 7.2 years. Which means if you have $10,000 at age 25, by 32 you have $20,000. You didn't do anything, you just waited. By 39 you have $40,000. By 46, $80,000. By 53, $160,000. By 60, $320,000. From $10,000, one investment, no additional contributions. That's the math. Now here's the uncomfortable part of the math. Every year you wait to start, you're not just losing 1 year of growth, you're losing one of those doublings at the end, the ones that do the real heavy lifting. The last doubling, from $160,000 to $320,000, happened in the same 7 years as the first doubling from $10,000 to $20,000. But it generated 16 times more dollars. This is why time is not just a factor in investing, it is the factor. Everything else is a distant second. And yet, the entire financial media industry, the cable channels, the newsletters, the hot takes, spends almost zero time on this. Because there's nothing to sell you here. You can't monetize patience. You can't charge a subscription fee for sitting still. What you can sell is the illusion that there's always something to do, a trade to make, a sector to rotate into, a crisis to react to. The industry needs you moving. Compound interest needs you still. These two things are in direct conflict. There's a version of investing that gets sold to beginners that goes something like this. Find great companies, buy low, sell high, repeat. It sounds logical. It sounds like a skill you can develop, and that framing is not entirely wrong. Active trading has made some people very wealthy. But here's the data. Studies going back decades consistently show that roughly 80 to 90% of actively managed funds run by credentialed professionals with Bloomberg terminals and research teams underperform a simple S&P 500 index fund over a 15-year period. 80 to 90%. These are not amateurs. These are people with PhDs in mathematics who do nothing else for 60 hours a week, and most of them still lose to an index fund. Now think about what that implies for the average person trying to pick stocks on their phone between meetings. This isn't a knock on intelligence, it's a structural reality. Markets are extraordinarily efficient at pricing in known information. By the time you read that a company is doing well, thousands of institutional traders with better data and faster systems have already acted on it. The edge that amateurs think they have is usually noise mistaken for signal. And yet retail trading apps, beautifully designed, gamified, with little confetti animations when you make a trade, are designed to make you feel like an active participant in your financial future. Which you are, just not in the way the confetti implies. The research on retail trading is not ambiguous. The more frequently individual investors trade, the worse their returns tend to be. Transaction costs, taxes on short-term gains, emotional decision-making, buying high after a run-up, selling low after a correction. Behavior, it turns out, destroys returns far more reliably than bad stock picks. The single biggest threat to your long-term investment portfolio is not a market crash. It's you, in a panic, selling at the bottom. Every generation gets its version of the same story. In the 1990s, everyone was a genius because tech stocks only went up. Then they didn't. In the mid-2000s, you couldn't lose money in real estate. Until you could. In 2021, 23-year-olds on Reddit were teaching each other how to trade options on meme stocks. Some of them got very rich. Many more lost serious money. The ones who got rich made the headlines. The ones who lost didn't. Survivorship bias is one of the most persistent distortions in investing culture. You hear from the people who won. The people who applied the same strategy and lost are quiet. Crypto has run this entire playbook twice in 5 years. Enormous gains, enormous crashes, enormous amounts of media coverage of the gains, somewhat quieter coverage of the people who bought near the top. None of this means these assets are worthless or that nobody should touch them, but the way they get presented as obvious asymmetric opportunities that only a fool would ignore is almost always retrospective. The certainty arrives after the fact. The boring truth is that for most people, the investment strategy that actually works looks nothing like the content that goes viral. It's automated, it's consistent, it's deeply, profoundly unexciting. You set up an automatic contribution to a low-cost index fund. You contribute every month regardless of whether the market is up or down. You do not check it obsessively. You do not sell when it drops 20%. You do not move it into cash because the news is scary. You wait. That's it. That's the strategy that has outperformed the vast majority of professionals over the long run. It generates almost no content. It requires no apps. It produces nothing to share. It just works. Zoom out now, because there's a larger story running underneath all of this, and it's worth understanding. For most of the 20th century, wealth accumulation for the middle class was driven by wages and pensions. Work hard, stay loyal, retire with a guaranteed income. The system was imperfect, but it had a floor. That floor has been systematically removed. Wages, adjusted for inflation, have largely been stagnant for the bottom half of earners for 40 years. Pensions have been replaced with 401k plans that require individual employees to make investment decisions they have no training to make. Social Security faces long-term structural funding questions nobody in politics wants to seriously address. Meanwhile, asset prices, stocks, real estate, have dramatically outpaced wage growth over the same period. What does that mean practically? It means that people who owned assets got significantly wealthier. People who only owned their labor largely did not. This is not a political talking point, it's arithmetic. It shows up in the data across virtually every major economy. And the implication, if you follow it to its conclusion, is that investing has shifted from being a nice financial habit to something closer to a structural necessity for anyone who wants financial security beyond their working years. You don't have to like that. The argument that this represents a fundamental failure of economic policy is entirely reasonable. Many credible economists make exactly that argument. But you also have to live in the world as it is, not as it should be. And in the world as it is, not participating in capital markets is no longer neutral. It is, over time, a decision to fall further behind. So here's where we land. Investing is not complicated. The basic mechanics are genuinely simple. Low-cost index fund, consistent contributions, long time horizon. Don't panic. A 22-year-old who internalizes those 4 principles and executes them without drama will almost certainly be fine. But there's something worth sitting with before you go. The fact that a strategy this simple, this well-documented, this consistently supported by the evidence is still not widely understood, still not taught in most schools, still obscured by an industry that profits from complexity, tells you something. Not that there's a conspiracy. Markets are not a conspiracy. They're just a system. And systems, like water, flow in the direction of least resistance toward whoever benefits most from the current configuration. The question isn't whether you should invest. The data on that is fairly clear. The question is whether a society where financial security increasingly depends on the investment decisions of individuals, starting from wildly unequal financial starting points with wildly unequal access to information and time, is actually working. And that question doesn't have a tidy answer. What we do know is this. The 2 people at the beginning of this video, same city, same salary, same $200 a month, ended up in completely different places, not because of talent or luck or effort, just time. And time, unlike almost everything else in this system, is the one resource that's distributed with something close to equality. For now,